Two exchanges, one metal. And right now they cannot agree on what that metal is worth, and that disagreement is not a glitch, it is a confession. As of March 2026, silver futures in Shanghai are trading at a premium that, just 18 months ago, would have been considered structurally impossible. The gap between Shanghai physical prices and COMEX paper futures recently crossed $26 per ounce, a premium of roughly 24%. In a functioning market, arbitrage should collapse this spread in hours. Ships move metal, the price equalizes, but the gap persisted. When a market mechanism refuses to self-correct, that is not volatility, that is structural fracture. And that fracture runs directly to the center of how the global silver price is actually set, and who benefits from setting it where it is. Stay with me, because what's happening between Shanghai and Chicago is the visible surface of a deeper war over silver pricing. To understand why this matters, you need the structural difference between COMEX and the Shanghai Futures Exchange. COMEX is first and foremost a paper market. Data shows fewer than 2% of contracts ever result in physical delivery, 2%. The other 98% are cash settled or rolled forward. This means the price mechanism the Western world uses is set by participants who have no intention of touching physical metal. They trade claims on metal, derivatives of derivatives. And the system functions until someone actually wants the silver. The divergence is growing and the physical reality is starting to break through the paper claims. Keep watching this space. The Shanghai Futures Exchange and the Shanghai Gold Exchange operate under a fundamentally different philosophy. Chinese market architecture has always placed greater weight on physical settlement, and the domestic industrial economy creates constant pressure for physical delivery because the factory is actually consuming silver. The solar panel manufacturers, the semiconductor fabricators, the electronics assemblers, these entities need real metal, not a paper contract they can roll. When China's industrial base needs silver, it does not want a promise from a bank in Chicago. It wants the bars. This is the core causal mechanism that every downstream effect in this video flows from. One market prices silver based on financial positioning, the other prices silver based on physical industrial necessity. When those two realities align, the prices converge. When they diverge, you are watching the paper price lose its grip on physical reality. And right now, they are diverging at a pace that has not been seen in modern commodity market history. But here's the part nobody understands. This did not start with the price gap that appeared in January. It started with a policy decision in Beijing. Effective January 1st, 2026, China implemented a new licensing framework for silver exports. This was not a ban. It was more surgical than a ban, and therefore far more effective as a strategic tool. The new framework requires silver exporters to meet minimum annual production thresholds of at least 80 tons of silver and demonstrate verified credit lines exceeding $30 million. What that single policy did, functionally, is eliminate the majority of China's smaller and mid-sized silver refiners and exporters from the global market overnight. China currently controls between 60 and 70% of the world's refined silver supply, so even a partial restriction on export licensing does not create a supply disruption at the margin. It creates a supply shock at the center of the global system. And this is where things get structurally dangerous, because the West's response to that shock is constrained in ways that policymakers have not been honest about publicly. Let's walk through the three structural forces that are now operating simultaneously, because each one alone would be significant. Together, they are creating a situation where the COMEX pricing mechanism is being challenged at its foundation. The first structural force is the fractional reserve nature of Western silver markets colliding with the physical delivery cycle. COMEX operates what is effectively a fractional reserve system for metal. As of mid-March 2026, COMEX registered silver, meaning silver that is immediately deliverable against futures contracts, stands at approximately 79 million ounces. Total paper claims outstanding, meaning open interest across futures contracts, exceed 579 million ounces based on exchange warehouse data from March 13th. That is a ratio of roughly one physical ounce backing 7.34 ounces in paper claims. In normal market conditions, that ratio does not matter. Because the overwhelming majority of holders never demand delivery, the system works on trust and inertia. But when the incentive to take physical delivery increases, and right now that incentive is the highest it has been in this entire silver cycle, the fractional reserve mathematics become structurally explosive. The second order effect of this mechanism is that as delivery demand increases, registered inventory declines. A single-day withdrawal of over 3.25 million ounces from COMEX registered inventory was recorded on February 11th of this year. When registered inventory falls, the ratio of paper to physical gets worse, not better. This creates a self-reinforcing dynamic where each large withdrawal increases systemic fragility, which increases the urgency for other sophisticated holders to also take delivery, which triggers further withdrawals. This is not a theory. It is the mechanics of a bank run applied to a commodity exchange. The only structural difference is that the COMEX rulebook allows for cash settlement under extreme conditions, meaning the exchange can, if it chooses, pay out in cash rather than deliver metal when delivery demand overwhelms available inventory. That option is what keeps the system from formally defaulting. But the price at which cash settlement occurs is still the COMEX paper price. And if enough large participants decide that cash settlement at the paper price is unacceptable because physical silver in Shanghai is trading 24% higher, you have created an incentive structure that is actively destabilizing the existing pricing architecture. The second structural force is China's industrial demand acting as a one-way valve on global silver inventory. China accounts for somewhere between 35 and 45% of global silver demand. The industries driving that demand, photovoltaics for solar panels, advanced electronics, electric vehicle components, are not discretionary consumers. A solar panel manufacturer operating at scale cannot choose to use less silver this quarter because the price is high. The silver content is built into the process chemistry. You cannot swap it out on a short timeline without retooling an entire production line. This means Chinese industrial demand operates at a structural floor that does not respond to price signals the way financial demand does. When silver prices rise, a hedge fund reduces its position. When silver prices rise, a Yangtze River Valley solar wafer manufacturer does not reduce its production. The third order effect here is what makes this particularly acute. China's export restrictions, combined with this inelastic domestic demand, means that metal flowing into Chinese industrial use is increasingly unlikely to flow back out. Shanghai is not just bidding for silver. Shanghai is sequestering silver. Every ounce absorbed into a Chinese solar panel is permanently removed from the tradable global float. And as that float shrinks, the COMEX registered inventory, which depends on metal being available and willing to move, faces structural attrition that mine supply cannot offset in real time. The Silver Institute projects a 67 million ounce deficit for 2026, marking the sixth consecutive year of structural market shortfall. 6 consecutive years. Total annual mine output is projected to reach approximately 1,050 million ounces at best, still insufficient to close the gap between supply and the combined weight of industrial consumption and investment demand. The third structural force is institutional positioning and the incentive structures that have trapped Western financial players in a self-defeating feedback loop. The major banks and financial institutions that hold large short positions in COMEX silver are not shorting silver because they have a fundamental conviction that silver is overvalued. They are short silver because the paper market structure has historically rewarded that positioning. When you can sell paper claims on metal that will likely never be delivered and roll those positions forward at minimal cost, the short side of the trade carries a structural carry advantage. The institution collects the spread between the futures price and the expected rollover cost and closes the position before anyone asks for delivery. That model worked when the gap between paper and physical was negligible and when arbitrage kept the two prices in sync. But here is the constraint that now traps those institutions. The Shanghai premium has destroyed the arbitrage mechanism. Normally, if COMEX silver trades at a discount to Shanghai silver, an arbitrageur buys COMEX futures, takes delivery, ships the metal to Shanghai, and sells into the higher-priced market. The spread collapses. The two prices reconverge. But China's export licensing restrictions have effectively blocked that metal flow in the reverse direction. Silver is moving into China, but the institutional and regulatory infrastructure to move large volumes back out does not exist in the way that would be required to monetize the arbitrage at scale. The one-way flow dynamic means the Shanghai premium can persist and widen without triggering the natural corrective mechanism. And while that premium persists, the short side position in COMEX becomes increasingly dangerous because every uptick in physical delivery demand from COMEX narrows the distance between the paper price and the pain threshold for those short positions. The second order effect is that attempts to defend the short position, margin adjustments, contract rule changes, forced liquidation of long positions, are increasingly visible to the market. When the rules change mid-game, sophisticated participants do not conclude the system is functioning. They conclude the system is being protected, and when a market's credibility depends on it being perceived as neutral, the moment participants believe it is being administered to protect specific institutional interests, the price signal it produces becomes structurally unreliable. This is not a fringe position. This is the logical inference from the observable behavior. Now project this forward, because this is where the causal chain we have been building either resolves gradually or breaks sharply. The mainstream narrative on silver right now is that prices have corrected from recent highs and that the market is finding a new equilibrium. That framing misreads the structural situation entirely. Equilibrium requires that supply and demand can clear at a price both parties accept through a mechanism both parties trust. What we currently have is a Western paper pricing mechanism that is structurally losing its capacity to represent physical scarcity, because the metal it is supposed to represent is increasingly concentrated in a jurisdiction that has explicitly restricted its outflow. The price at which COMEX currently clears is not a price that reflects the replacement cost of physical silver in the global industrial economy. It is a price that reflects the cost of a paper claim on metal that may or may not be deliverable when the claim is actually exercised. Policymakers in the West face a genuine impossible choice here. They can attempt to maintain COMEX's role as the global price-setting mechanism by defending the current registered inventory levels through regulatory intervention, relaxing delivery requirements, or allowing cash settlement at scale. But each of those options either depletes national strategic reserves, reduces institutional credibility, or confirms to sophisticated market participants that the paper price and the physical price have formally decoupled. Alternatively, they can allow the COMEX price to converge upward toward the Shanghai physical price, which means acknowledging that silver has been systematically underpriced relative to its industrial scarcity value, with enormous implications for every industry, every government program, and every financial institution that has been operating on the assumption of cheap silver being available indefinitely. There is no version of this resolution that does not involve a substantial repricing. The only variable is whether that repricing happens through controlled convergence or through a disorderly break in the paper-to-physical relationship. The Silver Institute's deficit projection is not a forecast of temporary imbalance. 6 consecutive annual deficits means the above-ground stockpiles that have been quietly absorbing the gap between production and consumption are not infinite. They are being drawn down. Every year that the deficit persists, the buffer between the paper market's assumptions and physical reality gets thinner. What the causal chain established in this video tells you is not where the price goes tomorrow. No serious analyst pretends to know that. What the mechanics tell you is the direction of structural pressure. Physical demand from China is not going to reverse. Export restrictions are not going to be lifted. If anything, Beijing has demonstrated through its rare earth playbook that once these restrictions are in place, they become permanent tools of strategic leverage. COMEX registered inventory is not going to rebuild meaningfully while the Shanghai premium exists and institutional arbitrage remains structurally blocked. The deficit is not going to close on the supply side within a time frame that stabilizes the system. These are not speculative variables. They are observable, directional forces operating in real time. What this means at the level of structural positioning is straightforward. The risk-reward calculation for believing that the current COMEX paper price represents durable, reliable price discovery has deteriorated materially. The instruments, the timelines, and the specific allocation decisions are yours to make, ideally with qualified guidance. But the structural direction of the forces is not ambiguous. Here is what I want to leave you with. Every major commodity pricing regime in modern history that has separated from physical reality has eventually been forced back into alignment with it, not by markets becoming more rational and not by policymakers making better decisions, but because physical scarcity is a harder constraint than financial engineering. You can create unlimited paper claims. You cannot print silver bars. The Shanghai premium is not a technical anomaly to be dismissed in a footnote. It is the most honest price signal in the global silver market right now. It is the market's physical reality asserting itself against a pricing infrastructure built on the assumption that delivery would never actually be demanded at scale. The question that should keep you thinking long after this video ends is this one. If the COMEX price is what gets quoted on every financial terminal, every news headline, and every brokerage statement, but the price at which physical silver is actually changing hands in the world's largest consuming market is 20 to 25% higher, then which number is telling you the truth about what silver is actually worth? And what happens to every asset, every industry, and every institution that has built its model on the cheaper one being real?